What if I told you that paying higher fees to beat the market is actually the #1 reason most individual investors fail? It sounds counterintuitive, doesn't it? We are taught in school that hard work pays off, and in the financial world, we are often sold the idea that a professional manager working harder than we do should naturally give us better returns. But the data tells a different story. Over a 20-year period, more than 80% of active mutual funds fail to beat the simple market average. Today, on Fiscal Beacon, we are going to clear up the confusion. We're breaking down exactly what a mutual fund is, what an index fund is, and why the difference between the two could save you tens of thousands of dollars over your lifetime. Let's start with the basics. Imagine you have $10,000 to invest, but you don't have time to research hundreds of companies, read their quarterly reports, or monitor their stock prices all day. You want exposure to the stock market, but you don't want to pick individual stocks. This is where a mutual fund comes in. Think of a mutual fund like a potluck dinner, but organized by a professional chef. You, along with thousands of other investors, throw your money into a big pot. A professional fund manager then takes that pool of money and buys a diversified basket of stocks. Maybe they buy 50 different tech companies or 100 different healthcare stocks. The key here is the word active. The fund manager is actively making decisions. They are buying and selling stocks based on their research, trying to find the winners before anyone else does. They are trying to beat the market. For this service, they charge a fee. This is known as an expense ratio. In a traditional actively managed mutual fund, this fee might range from 0.5% to 1.5% or even higher. Let's say you have a $100,000 portfolio in an active fund with a 1% expense ratio. That means you are paying $1,000 a year, regardless of whether the fund makes money or loses money. That fee is deducted from your returns automatically. Now let's look at the alternative, the index fund. If a mutual fund is a potluck organized by a chef, an index fund is like buying a prepackaged grocery store brand that includes one of every item in the store. You don't have a chef picking and choosing. Instead, the fund simply tracks a specific market index, like the S&P 500. The S&P 500 is a list of the 500 largest publicly traded companies in the U.S. If you buy an S&P 500 index fund, you are buying a tiny slice of all 500 companies. If Apple goes up, your fund goes up. If Amazon goes down, your fund adjusts. The manager of an index fund doesn't try to pick winners. Their job is passive. They just want to replicate the index. Because they aren't doing all that research, trading, and analyzing, their fees are drastically lower. While an active mutual fund might charge 1%, a major S&P 500 index fund might charge just 0.03%. That is a massive difference. Let's look at that $100,000 portfolio again. In the index fund, you pay $30 a year. In the mutual fund, you pay $1,000 a year. Over 30 years, assuming a 7% average annual return, that $970 annual difference compounds. In the mutual fund scenario, you end up paying nearly $100,000 in fees. In the index fund, you pay less than $2,000. That is $98,000 left in your pocket, purely because you chose a passive strategy. This brings us to the most common question we get at Fiscal Beacon. But what if I want to beat the market? Isn't that the goal? Here is the hard truth. Beating the market consistently is incredibly difficult. Even professional fund managers with teams of PhD economists and billions in data tools struggle to do it year after year. And remember, you are competing against them, but you are also paying them more. It's a double disadvantage. Let's use an analogy. Imagine two runners in a race. The mutual fund manager is like a runner who has to carry a heavy backpack full of equipment, the fees, and the research burden. The index fund investor is like a runner who just follows the path laid out by the race organizers. The path, the index, represents the average market performance. The runner with the backpack might have a burst of speed, but over a long distance, the extra weight slows them down. The runner following the path might not be the fastest in the world, but they are consistent and they aren't weighed down. Over a 20-year investment horizon, the consistent, low-cost runner usually finishes ahead of the heavy, expensive one. Now, I need to be clear here. This is not financial advice. Every individual situation is different. You should always consider consulting a financial advisor to discuss your specific goals, risk tolerance, and tax situation. However, the general principle holds true. For the vast majority of long-term investors, low-cost index funds are the more efficient vehicle. But wait, are all mutual funds bad? No, some mutual funds are actually index funds. This is where the terminology gets confusing. Technically, an index fund is a type of mutual fund. The distinction we are making today is between actively managed mutual funds and passively managed index funds. Many people use the terms interchangeably, but the management style is what matters. When you see a fund with a name like Smith Capital Growth Fund, that is likely an active fund. When you see a fund named S&P 500 ETF or Total Market Index Fund, that is passive. There is one other nuance: tax efficiency. Actively managed funds tend to generate more capital gains distributions because the manager is buying and selling stocks frequently. This can create a tax bill for you, even if you don't sell your shares. Index funds, because they buy and hold, tend to be more tax efficient. Again, this is a generalization, and tax laws vary, so check with a tax professional. So, how do you choose? If you are busy, skeptical of hype, and want to build wealth steadily over time, an index fund is likely your best friend. It requires less monitoring, has lower fees, and historically provides market average returns, which are very hard to beat. If you have a high tolerance for risk, enjoy researching companies, and believe you can identify undervalued stocks, you might choose individual stocks or active funds. But be prepared to put in the work, and be prepared for the likelihood that you may underperform the market. Here is your actionable takeaway for this week. Go to your brokerage account. Look at any active mutual funds you currently hold. Check their expense ratios. If you see a fee over 0.75%, do the math. Imagine what that money would look like if it stayed in your pocket for 20 years. Then, consider if there is a low-cost index fund equivalent that tracks the same market. You might not need to switch immediately, but understanding the cost is the first step to taking control of your financial future. If you found this breakdown helpful, please give this video a thumbs up. It helps us reach more people who are trying to make sense of their money. And if you haven't already, hit that subscribe button and turn on notifications. We are releasing a new video next week where we dive into the 3-step portfolio allocation strategy for beginners, showing you exactly how much to put in stocks versus bonds based on your age. You don't want to miss that. Remember, knowledge is power, but only if you apply it. At Fiscal Beacon, we aim to be your beacon in the fog of financial jargon. Keep learning, keep investing, and we'll see you in the next one.